I came across this article and I wanted to share it with you. This is part of a new series that I created on the channel. I am now uploading videos on Thursdays where I review articles that, catch my attention, things that I think would be interesting and, things that I would love to share with you and have a conversation about. And yeah, that's what I am going to be doing here on Thursdays. This is going to be the third video of this new series. But yeah, let's take a look at it here. So the article is how to build an 8% yielding SWAN, so sleep well at night, portfolio with 10 blue chips. The article was written here by Dividend Sensei. I've been following Dividend Sensei for a while now. I really like his work. And yeah, the article, it's interesting if you're trying to build a dividend portfolio. I talk a lot about that on my channel, and I talk about the core and satellite approach to investing. I talk about how to invest based off of your investment time horizon. And so I'm going to review the article. I'm going to read the article here and discuss it with all of you and share some tips and things to consider if you yourself are trying to build a dividend portfolio. So the article starts off here with him writing that a high yield dividend investing is a popular retirement strategy for its steady income, low volatility, and potential to outperform the market. JP Morgan's Equity Premium Income ETF, or JEPI, offers an 8% yield that lacks dividend growth. Over a standard retirement, inflation is expected to be more than 100%. By combining JEPI with a portfolio of 10 blue chip stocks yielding 7%, investors can achieve an 8% yield with stronger long-term dividend growth potential. So the key thing here with the article is he's arguing that instead of just going with JEPI with no dividend growth, it would be wise to combine it with other stocks that are yielding, 8% that have maybe a little bit more growth or dividend growth potential. These 10 blue chips yield 7.3% and are 19% undervalued and are growing 6%. And have 32% total return potential in the next 12 months. The combined 8% yielding portfolio has 3% consensus long-term dividend growth potential, keeping ahead of inflation and potentially generating 11% total returns, better than SEHD, the current high-yield gold standard ETF, with a 10% long-term total returns. So I really like how he's prefacing this, that he doesn't speak specifically about the core and satellite approach to investing, but he does what he's describing is the core and satellite, right? Where you're getting a balanced portfolio, you're combining yield with dividend growth, and you're mixing that into kind of the perfect mix to meet what you're trying to do, what your ultimate goals are. And so I am Dividend Sensei, aka Adam Gallus. He's an Army vet. Okay, cool. So let's take a look at the article here. He writes that high yield dividend investing is a popular retirement strategy and it's easy to understand why. Are you tired of worrying about interest rates, the Fed, geopolitics, US politics, or the economy? Wouldn't it be fantastic if you could buy great companies, collect low risk and steady growing dividends, and ignore the stock market volatility entirely? Well, yes, that would be great, but act now and you'll also get this little Swiffer wiper, and it sounds like Mr. Clean, those infomercials. But wait, there's more. Oh man, love it. All right, next he writes here, nobody can predict interest rates, the future direction of the economy, or the stock market. Dismiss all forecasts and concentrate on what's happening to the companies in which you've invested. It's a great quote from Peter Lynch. That's precisely what blue chip investing can accomplish if you know how to do it right. So how to build an 8% yielding portfolio that can potentially deliver 10 to 11% income growth. Last week, I looked deeper into JP Morgan's JEPI's 8% yield and why it's an ETF, why that ETF is an excellent choice for two kinds of investors. However, JEPI has its limitations, as the article explores in detail. One of those limitations is that JEPI is designed to generate 7 to 9% long-term yield, which is pretty much the only source of its returns. In other words, income growth is not JEPI's strong suit, and you shouldn't expect much or necessarily any dividend growth from that ETF. So Dividend Sensei is 100% correct here. Whenever I do my own forecast for my portfolio, I calculate dividend growth at 0, right? I like to be pleasantly surprised, and I have zero expectations for the growth of the yield in JEPI, and JEPQ is as well, kind of. Now, JEPI is tracking the S&P 500, where JEPQ, both from JP Morgan, tracks the NASDAQ. And you could reasonably assume higher income, higher growth, which you've actually seen if you invested into both. You'd see that more with JEPQ. So yeah, both great ETFs, both I own. And what Dividend Sensei is showing here is the historical income likelihood, or the income that the premiums that you would expect from a cover call strategy like one that we see here in JEPI. And he's showing over time, averaged out, depending on where the market is. Sometimes it's going to be higher, sometimes it's going to be lower, depending on market volatility. But you could assume an average premium of about 8%. And JEPI generates 85% of its income from equity-linked notes, a cover call strategy with volatile income depending on market volatility. Yeah, the other 15% is from the underlying stock, the dividends from the stocks held in the fund. So JEPI's historical dividend growth is just slightly negative annually for the last 4 years. And looking at the graph here, he's showing the income, just the income, not the total returns of the JEPI index, SHD, and VYM. The JEPI index income has been kind of all over the place. You can kind of disregard 2018 because the full year is in 2019, and you'll see that, it's kind of been up and down, whereas SHD and VYM have been more consistent. So JEPIX is JEPI's institutional mutual fund class sister fund, which requires a $1 million minimum investment and charges a 0.6% expense instead of JEPI's 0.35%. I always wondered why the institutional ones were higher and charge higher fees. Kind of weird. Anyways, it uses the same manager's strategy and portfolio, but began running in the mid-2018s. Its first full year income was in 2019 when $1,000 invested generated $78 in dividends, a 7.8% yield. Just like today, JEPI is designed to deliver an 8% yield long term. It's not designed to deliver dividend growth, and from 2019 to 2023, JEPI's dividend has dropped slightly to $77 per 1,000 invested, or a 7.7 yield on cost. But look at SHD and VYM, which are focused on low risk, high yield, dividend growth blue chips. VYM has a 5% annual dividend growth, and SHD has a 11.0% annual dividend growth. Did everybody see the SHD dividend growth here this last quarter for June? It's like 24% year over year. Massive, massive. SHD is an absolute beast. Let's move on here. So analysts expect VYM's dividends to grow about 7% annually and SHD 6%. I think this is a little bit low, 6%. But that means that VYM and SHD will ultimately deliver higher retirement income over time than JEPI, especially in a taxable account where 4% of JEPI's 8% yield or return is subject to tax on average. But what if there was a way to harness JEPI's powerful 8% yield and build an entire portfolio around it, an 8% yielding portfolio that can deliver the same 6 to 7% income growth as analysts expect from SHD and VYM? Sounds pretty good to me. How would you like to enjoy twice the yield on day one and potentially enjoy the same long-term income growth? That would be having your cake and eating it too. And here's how you can potentially accomplish this impressive feat. So this is where he talks about combining both of them, right? He doesn't directly say, the core and satellite, but combining it in a well-diversified portfolio. How to build an 8% yielding blue chip dividend growth portfolio using JEPI. The Zen investing strategy involves taking 50% of core ETFs and augmenting them with individual blue chip stocks. That allows you to maximize yield growth valuation or any other investing factor you care about. I've seen this yield investing strategy in the past. I'm trying to recall exactly what it is. I'll have to research it afterwards. If you're familiar with that approach, leave me a comment and leave me your thoughts on that. I'd be curious to hear what you think about the Zen investing strategy. Anyways, in this case, we love JEPI's 8% yield. We don't like the lack of income growth. What if we could find a group of 10 blue chips that yield 7 to 8%? Then we'd have an 8% yielding blue chip portfolio with superior long-term dividend growth potential and total return potential. how can you find a blue chip portfolio that yields 78%, 7 to 8%? Well, what he's showing here in this table is the Zen Research terminal screening criteria. So I'm assuming this is not his own way of screening it. It's looking at the different fundamentals of a stock, the investment credit rating. Is it speculative versus non-speculative? Start by selecting any reasonably priced companies and then blue chip quality or better based on safety and quality. Then crank up the quality screen even more with investment grade credit ratings. Okay, I like that he's focusing on the credit rating because when you're going after an 8% yielding stock, if a stock is trading, it has a forward yield of 8%, there's probably a reason for it. And so focusing on the credit rating is an interesting approach to focusing on quality. So I like what he shows here, that companies with a credit rating of AAA have less than a 1% probability of going bankrupt in 30 years, whereas a company with a credit rating of D have a 100% probability of going bankrupt in 30 years. Interesting. I personally have not looked at individual stocks from that perspective. So it's an interesting take, something that I probably should do more in the future. Interesting. According to S&P, investment grade credit ratings are BBB or higher and represent 11% or smaller 30-year bankruptcy risk. Next, screen out any speculative companies undergoing complex and highly uncertain turnarounds, for example, Walgreens, VFC, 3M, Leggett & Platt, and AT&T. These speculative former dividend aristocrats are still in investment grade, and credit ratings are not designed to predict dividend cuts. They're just bond defaults. Finally, since the goal is to earn the same kind of long-term returns or better and income growth as SEHD and its 4% yield and 10% dividend growth consensus, we use a 10% plus long-term return consensus. Okay, so it's getting that magic sauce, right? Getting the right balance of growth, income, and growth. Okay, and over the long term, valuations tend to cancel out, and yield plus growth generates 97% of long-term investing returns. Okay, that's how we can find the best 7 to 8% yielding blue chips to combine with JEPI to create an 8% yielding portfolio with stronger long-term dividend growth potential. So that's his methodology of how he's selecting which companies to start with. Right? That's your list. That's your filter. And then here are the 10 blue chip stocks yielding at least 7%. And so what he has in here is British American Tobacco, BTI, Altria Group, MPLX, TC Energy, Enbridge, Energy Product Partners, so EPD, Bank of Nova Scotia, Pfizer, even though Pfizer is a 7% yield, I don't know how, he's doing the cumulative, the total weight yield. Pfizer, Vici Properties, and Main Street Capital, which gives you an average yield of about 7.37%. And so the 7.4% average yield with an 88% average safety score based on more than 1,000 fundamental metrics, that translates into a very low risk dividend income stream with approximately a 0.5% risk of a cut in an average economy and around a 1% risk even in another Great Recession or pandemic level downturn. The overall quality of these companies is 84%, a super sleep well at night aristocrat level quality. The 84%, okay, I mean, that's based off of his criteria, the metrics that he's using here. And the throw in the added super sleep well at night. I mean, okay, it's not only sleep well at night, it's super sleep well at night. Okay, how do we quantify super? I need a metric to quantify super. Help me understand, what does super mean? Anyways, these companies are 19% historically undervalued relative to their 10-year averages. Combined with their yield and growth consensus for the next year, that translates into 32% fundamentally justified total return potential over the next year. I'll get to this in a second, but he's really taking an approach on, what is the value of the company and where is it historically traded? Where is it trading today? And that's kind of how he's getting this undervalued potential. It's not a forecast. If these companies grow as expected and return to a 10-year average historical fair value, then 32% of the total return would be 100% justified by the fundamentals. Does the S&P, NASDAQ, and Magnificent 7 have a 32% upside to fair value potential? Nope. They could only deliver such returns through a speculative mania bubble. Okay, that's a pretty big assumption, so let's see what he has to say about that to back that up. These 7% yielding blue chips could deliver those gains 100% sanctified by the righteousness of fundamentals. Here's what that means. Say the S&P somehow goes up 32% in the next year. That would represent a 20% price to earnings expansion from 20x forward earnings to 24x forward earnings. For context, the highest forward PE the S&P ever achieved was 25 in March 2000, the peak of the tech bubble. If the S&P 500 trades at a 24 times multiple forward earnings, that represents approximately a 25% historical premium, which would be the second most overvalued market in US history if applied, or if happened. So what kind of returns would you expect over the next 5 years in this scenario from 2025 to 2030? Well, a 1% yield plus 12% growth equals a 13% total return, and a minus a 6% annual valuation drag, so a 7% annual return potential from 2025 to 2030. Compare that, so that was the S&P 500. Compare that to the high yield blue chips, which could deliver 32% returns while merely returning to fair value. 4.8% fair value yield plus a 6.1% growth plus a zero valuation change equals a 10.9% annual return potential for 2025 to 2030. So he's looking at the valuation. This is a little bit risky to do because you're assuming that if a stock goes down, it's going to go back to the reversion to the mean. You're assuming if a stock has traded historically at a certain PE over the last 10 years, that it will automatically go back up, to its historical average. I agree with that, but I don't think it's that simple. If you're comparing the growth potential, I guess what he's arguing is, do you believe more that NVIDIA, which is carrying the market in the Mag 7, Magnificent 7, are going to continue carrying the market? Or do you believe that these undervalued, out of favor dividend stocks are going to outperform? And it really comes down to, what do you believe? Because now we're in crystal ball territory, and I just don't know. It's the value investor's dilemma. So continuing on, so you can see the benefit of buying quality high-yield blue chips at a 19% discount. According to the FactSet consensus, these blue chips are growing at 6.1% annually. This is the median long-term growth forecast from all analysts who cover a company for a living. Remember that SHD has a 6% long-term growth consensus and yields 4%. These blue chips yield 7.4%, almost twice as much, but grow just as fast. These 10 blue chips are expected to deliver about 3.5% better annual returns than SHD. That's 3.5% long-term total return potential and income growth potential if you reinvested the dividends. Okay, so now he's comparing the historical returns of his stocks versus the S&P 500. Historical returns since 1999, it shows an 11.9% CAGR versus the 7.7% CAGR for the S&P 500. So his 10 blue chips since 1999 have outperformed on a total return basis, going back to that point. While historical returns are not a guarantee of future results, for stable blue chip businesses, we can have more confidence in analyst estimates if historical returns are consistent with long-term consensus estimates. This is impressive, especially considering these 10 blue chips are mostly in bear markets. As a result, they are almost 20% undervalued and yielding 7.3%. So I have this marked in red because I don't like what he did here, where he made one argument comparing with SCHD, and then another argument comparing with the S&P 500. If you're going to make a comparison, it has to be consistent. Otherwise, you can flip the data and make the data appear to be something that it maybe isn't by just changing some data points. Okay, so the message here is that the total returns have done well for his 10 stocks that he's recommending, and he's comparing them against SHD and the S&P 500 my argument here, what I don't like, I guess, so much is that he's using different data points to make kind of the same argument. And so for consistency, I would much prefer a comparison from the S&P 500 or the SHD and keep it consistent. So I'm not a big fan of that. What he has here, you can paint a completely different picture and you can mislead people if you're using different data points to make a similar argument. Okay, so that's just my opinion. Whenever I make YouTube videos and I compare different investments, I try to keep it apples to apples so that I don't mislead people when I'm trying to make a point and outline, you know, what I'm trying to show here. So that's my own thing here. So rolling returns smooth out bear markets. 12% to 14% rolling returns, similar to what analysts expect going forward. Note that the worst rolling returns are far superior to the S&P 500 thanks to the tech bubble and Great Recession, when these blue chips fell just 35% compared to the market being cut in half. Yeah, dividend stocks are generally a safe haven for investors, and they still go down in bear markets, just not as much. Historically, these are lower volatility companies that fall 48% as much as the S&P 500 in downturns, while rising 76% as much in the S&P 500 in up markets. Their historical safe perpetual withdrawal rate is nearly 2 times that of the S&P 500. That's why it's important that you understand what kind of investor are you. Are you in wealth accumulation phase of your life or preservation? If you're trying to preserve your wealth, well, you don't want the volatility. You want to take a step back from the overall market exposure, focus more on, you know, if you're more income oriented. So it's really, really important that you understand what phase of life you're in. Okay. So this could be a positive or a negative. Like say, for example, you're in your early 20s, you want volatility. You want the market to go up and down so you can take advantage of that as your dollar cost averaging into your portfolio over an extended period of time. The worst 15-year return was 8.44% per year, more than double the S&P 500's worst 15-year return. 14% annual income growth for 24 years. Okay, yeah, not too shabby for, I mean, that's pretty good. 14% average annual returns and 14% income growth. Total returns drive long-term income growth. A high yield isn't enough unless your time horizon is 10 years or less. For those with a more extended time frame, you must keep total returns and cumulative growth in mind. Yeah, 10 years, I would probably lower this probably to like 5 years. I think I wouldn't recommend going this approach if you have 10 years. Like, I think 5 years or less, personally. I like, for example, JEPI, guys, you've heard me say this a million times. Do not invest into JEPI if you have a 10-year time horizon. 5 years or less. Don't even consider JEPI, because as he mentioned here, the total returns, it's not worth it. It's not worth it. You can check out my other videos that I've made on it. Make sure that you understand how to invest based off your time horizon. The portfolio income, 8% annualized dividend growth. That's pretty good. How about the dividends themselves? Analysts expect 6% long-term dividend growth for investors who spend all of their income rather than reinvest it. Historically, the dividend growth rate was 8%, but you don't have to wait decades for potentially significant returns from these 7% yielding blue chips. Yeah, I mean, that's just the reality, right? When you invest into a stock that is, you know, yielding 7 or 8%, you get that 7 or 8% today, assuming that it doesn't get cut, versus if you're investing into a company like Coca-Cola, getting a 3.5%, how many years is it going to take for you to get up to a 7 or 8%, right? So really, really important that you understand that at the end of the day, it's just math. Consensus 2026 total return potential. It's not a forecast. Consensus return potential. These are the expected returns if and only if these companies grow as expected and return to historical fair value by the end of 2026. Fundamentals would justify that. So he's just looking here over until 2026. The average is 76%, equals a 20.8 annually versus a 40% or a 12% annually S&P. So 1 year fundamentally justified upside potential is 32% versus the 7% of the S&P 500. So this is going to be a little bit funky and maybe a little bit difficult to understand. This is referencing back to what he's referring to when it comes to the potential. Do you want to invest into a high multiple PE S&P 500, or do you want to invest into distressed high yielding dividend stocks, hoping and assuming that they will return to their historical fair value? That's the argument that he's making, and that is for the reader and for the person to decide what is right for you. So the first one is British American Tobacco. In terms of full disclosure, I own this company. It's a tobacco company. For better or for worse, it's a great dividend stock, great for taxes. I am a firm believer in people having the choice to do what they want. I'm a pro freedom type of person. If somebody wants to smoke, do it. Just don't make me smoke, smell your secondhand smoke. That's my take on it. Do what you want to do, live and let live. However, when it comes to BTI, the argument that he's making here is that, well, it's undervalued today, therefore it should go back up in price. That's kind of an oversimplified argument that he's making. It should go back to historical means, which I actually generally I agree with that. The reversion to the mean is real. I just want to share with you really quick, there's a reason why stocks are down. Okay, for one reason or another, whether you agree with the case or not. You look at when the share price started going below its historical average. It's right around 2017-18. I was in Germany, in Europe during this time period, right? This is a UK company, British American Tobacco. Back in 2016, wasn't that right around Brexit? Do you guys recall Brexit? British American Tobacco is based out of the UK. How did Brexit impact the exports, imports, the trade, the costs of exporting their goods? How did that impact their business? A lot of UK companies got impacted by Brexit, okay? So there's a reason why the stock fell. Now, another reason, this is kind of a hot topic, but it's the reality of investing into individual stocks. What happened in early 2022? Do you remember what happened in early 2022? There was a war going on in Russia and in Ukraine. And as a result of that, companies, US-based companies and European-based companies were forced, in many cases, to exit their operations in Russia. And that happened. You saw that with McDonald's. You can't buy a McDonald's hamburger in Russia anymore. You can't buy a cigarette from American Tobacco, American cigarettes or European cigarettes in Russia. And Russia is one of those markets that was a growth market for British American Tobacco. Well, the facts have changed. It's no longer a market in which they're operating. So the idea of the 10-year historical average, going back to what it was average, well, guys, we're living in a new reality. The average and the reality of 2013 or 2015 is no longer the case in 2024. So you have to understand, when the facts change, it doesn't necessarily mean that by default, a stock will go back up to its historical average. Maybe the historical average has now adjusted. Okay, so I'm sharing that with you. I'm not really bearish on the stock. I own British American Tobacco, but it's important to look at the facts and try to understand that maybe there's a reason why the stock is down. And not all companies revert back to the mean within a reasonable time frame. It could take another 10 years. You just don't know. And that's the risk that you run with investing in individual stocks. All right, so moving on, we got Altria Group. This is a company also that I own, also a tobacco company, MPLX. I'm going to kind of breeze through these. If you want to pause the video and take a look at the fast graph here, you can see TC Energy, Enbridge, okay, EPD. My dad is heavily invested into EPD, really, really heavy in this one. Bank of Nova Scotia, bank out of Canada, if I'm not mistaken. Pfizer, we all know what happened with Pfizer. Vici Properties, okay, and Main Street Capital. Risks to consider. It's critical to remember that any recommendation is always a snapshot in time. The data says that greater companies today might not be in a few months or years. They might come in and out of favor. Something might change. I utilize the approach Ben Graham recommended, looking at the past, present, and likely future, both objective data and qualitative analysis, the math and the story behind each company. I utilize the median consensus forecast from every analyst covering companies on Wall Street. This, of course, is not a perfect system. There is no such thing. The consensus can and does change over time. This is why there are no guarantees on Wall Street. It's all a series of probability curves. I like that. That's a really, if you don't understand that and you invest in the stock market, that's a huge wake-up call, guys. That's so important you understand that. Risk management is crucial, and asset allocation is the #1 place to start. Combining a high yield strategy like JEPI with pure high yield blue chips to maintain the portfolio's 8% yield can have adverse effects in the short term. Okay, so he's looking at this graph here that he has. He's looking at the historical return since 2018. We looked at it before since 1999, where it had over double, I think, the CAGR. Here it has less than a 7% CAGR since 2018. Once again, what changed in 2018? So in addition to the inherent single stock risk from owning any individual company, you must remember that the JEPI index is designed to be a very low volatility ETF with about a 12.5 annual volatility, similar to the 60/40 portfolio. While these 10 high yielding blue chips have averaged 40% downside capture over the last 20 years, they can be much more volatile in the short term, including falling 31% during the pandemic. Yeah, guys, the pandemic kind of hit everything, and not very many companies got spared. There was a few companies that got spared. I think Nancy Pelosi was investing in them. And other members of Congress were investing in them before everybody else. You always wonder how these politicians get so rich. You know, they're basically poor when they, they're just average when they go into office, and all of a sudden they have a beach house in Miami, and just, anyways, a whole nother topic. Gotta love it. Anyway, so also keep in mind that this is a pure value focused portfolio. The NASDAQ yields 0.8%, and this portfolio is 8%. But even though there should be no overlap between the kinds of investors who invest in the NASDAQ and the 8% yielding portfolio, I can guarantee you that in the future, as this ultra high yield portfolio underperforms the S&P and NASDAQ, which are growing at 12+% a year, some investors will feel market envy and fear of missing out, or FOMO. Yeah, it's hard to be a dividend investor. See SAHD up like what, 6% year to date, and the S&P 500 or the NASDAQ's up like 15%. It can sting a little bit, but the market works in cycles. It's up one year, it's down the next year. You just have to understand what type of investor you are. And he said that here above, there's no correlation or overlap between investors, growth and value or yield investors. Yes and no. It depends on who you are. I think it's a good idea to have a mixture of growth and value, so you kind of get the best of both worlds, but it depends on your particular situation, I guess. These portfolios and even the 60/40 are all designed to capture 65% to 85% of the market's downside. However, that lower volatility comes at a cost of just 60% to 80% of the market's upside. It might seem silly that anyone owning a diversified portfolio might benchmark against the best performing assets in that portfolio, but it happens more often than you think. Yeah, it's hard to not look at Nvidia and Meta and Apple and think, oh yeah, it's hard. I get what he's saying here. And he adds here asset allocation and decline. So if you're invested just purely into the stock market, you're going to have higher volatility. You're going to have a higher beta. You're going to have higher highs and lower lows. That's just part of investing in asset allocation. There are 3 keys to success in real estate, which are location, location, location. In long-term investing, 90 to 100% of returns are explained by asset allocation, and asset allocation. Nothing else will matter if you don't have the right mix of assets, stocks, bonds, cash, and alternatives for your goals. Ignoring diversification is a financial miscalculation. And it's important because the market works in cycles. One year, tech stocks are doing well. The next year, consumer staples are doing well. One year, bonds are doing well. The next, they're not. Like, that's the challenge. And especially if you're withdrawing you're living off of the shares, you're selling your shares, it's a little bit more, that sequence of return risk is a little bit higher than just living off of the income that your portfolio generates. With living off of the portfolio, you kind of have to calculate more for, is the income going to grow at 6% or 3% this year? It's kind of how you want to look at it. So it's a little bit different. Asset allocation peak declines during average bear markets since 2000. The more you have invested into stocks, the higher percentage the decline will be in a single year. And also on the contrary, the higher highs it will be. So they go kind of hand in hand. Moving on here, don't focus on maximizing returns, focus on maximizing long-term returns through several bear markets. Okay, if you can't stomach inevitable corrections, and if you panic sell, then even God's own investing strategy will fail you. The bottom line is, according to him here, to Dividend Sensei, JEPI is great, but if you want 8% yield and 6% dividend growth, consider these 10 blue chip yielding 7%ers. So JEPI is an excellent single ticker solution for two kinds of investors. Those using tax-advantaged accounts, like a Roth IRA, for example, and those seeking to replace the 60-40 traditional retirement portfolio. However, JEPI's downside, other than the 4% tax expense ratio, is that it doesn't generate dividend growth. It's not built for that. He's talking about in a taxable account. That matters because inflation is very real. The bond market expects a 2.4% long-term inflation rate over the next 30 years, which retirees must remember. So if you have a 20-year, say you're 65 and you expect to live until you're 85, you're going to have what? $1 is going to be worth 62 cents as an example, right? And let's say, you have 40 years in retirement, that $1 that you have, the buying power of $1 in 40 years will have just 38% of that dollar. So inflation's real. It's something to absolutely keep an eye on. Most retirees will experience cumulative inflation of 100% plus. Thus, a lack of dividend growth will significantly threaten their purchasing power and standard of living over the long term. This is why individual companies are augmenting JEPI to preserve that actual 8% yield and generate dividend growth above the rate of inflation is potentially attractive. 8% yield plus a 3% long-term dividend growth equals 11% long-term return potential and income growth for anyone reinvesting the dividends. In tax-advantaged accounts, permitting tax-free compounding. So in a tax-advantaged account, this works absolutely much better. So if you're over the age of 59 and a half, having this in a Roth IRA is the best way to go. 11% long-term returns and income growth are slightly ahead of SHD's 10% expected income growth and total returns. Given the low volatility of these blue chips and JEPI itself, the potential low volatility of this 8% yielding dividend growth portfolio might be what some investors need to sleep well at night while achieving their financial goals. So that is the article. All in all, I think he gives you a lot to think about. Let's first take a look at some comments and then I'll share my thoughts. So or you just buy all MO, so Altria Group. Yeah, just go 100%, man. Go gun-ho. Go all into Altria Group. There you go. What else have we got in here? What a great article. I'm in for 7 of these with EMB and Vici being my favorites. I have JEPI and SHD as well as some closed-ended funds, trying to create a mixture cocktail of growth and yield. Always appreciate your outlook and investing in life. Well, I think, this article is great if you have more of a short-term time horizon. He referenced 10 years or shorter. I think realistically 1 to 3 years or 5 years, right? 5 and below. If you have 10 years, I would not invest in a JEPI. Like cover call ETFs, you can completely put off to the side. You don't have to invest into them now. You're having the tax drag, especially if they're in a taxable account and you want to retire early. Do not invest in it. Like I'm telling you guys right now, no BS. If you're investing in a taxable account and you're planning on retiring early, do not invest into a JEPI or any other cover call ETF until a couple of years before you plan on retiring. You can always reallocate later. You could sell, a growth stock or growth index and reallocate, or you could add new money a couple of years before you start retiring. So don't start adding JEPI if you have a long-term time horizon. And in fact, I actually, he doesn't talk about it, but I actually like JEPQ a little bit more. JEPQ tracks the NASDAQ, which is inherently more volatile. Where's the income come from? It comes from volatility, and you also have more upside and growth potential with JEPQ. I own both JEPI and JEPQ, and I've seen, just in the last year or so that I've had JEPI, I think 2 years? I can't remember exactly. JEPQ is just greatly outperformed. It's actually one of my highest performing investments that I've had in my portfolio. So yeah, definitely check out JEPQ or consider both of them. I like JEPI because it's more of like a bond. Like I really look at JEPI as a bond, and it's stable, it's consistent, it doesn't go up or down too much. And whereas with JEPQ, I expect a little bit more growth. Dividend Sensei here in this article doesn't reference the core and satellite, but that's essentially what he's doing here. What he's recommending is if you want to build a portfolio that you're going to one day live off of, the first piece that you have to understand is how much money do you have to invest? What are your expenses? And then all it is it's a math equation. How much do you need invested and what yield do you need? If you need an 8%, well, you need to get an 8%. If you can get maybe a 6%, you're going to have a lot more options. You're kind of limiting yourself with an 8%, okay? Like say, for example, you have $500,000, right? And you're like, yeah, I don't know if I should work another year or two. I want to retire now. Well, if you only have $500,000 and you need X amount of income, well, you're going to need to look for Y amount of yield. If you're thinking, well, I don't want an 8%, I guess I need $600,000. Well, you may have to work a little bit longer or do something kind of in the middle, maybe burst a fire like I did. But once you understand how much income you need, then you can look at what yield you need. And then what you want to do, and I love that he highlights this here, is the inflation, the growth. You want to make sure that that investment is outpacing inflation. I personally like a 5, maybe 6% dividend growth rate. I'm more a fan of that than just a 3%. I personally would try to get a higher percentage. And that's why my core would have a higher allocation into SHD and DJRO, depending on your time horizon. The thing that I wanted to make sure that I highlighted here is if you're following an approach like Dividend Sensei is explaining here, to really make this sleep well at night, you want to limit the percentage that you have to individual stocks. Because we saw what happened with Walgreens, we saw what happened with AT&T and 3M, these former SWANs, right? And now he's talking about super swans. I would not classify these as super swans, by the way. These are definitely not super swans. But if you want to have that sleep well at night, if you follow the simple path to wealth with dividend investing that I talk about on my channel, where you have your core portfolio where about 60, 70, 80% of your overall portfolio are in high quality dividend ETFs. My favorites are SHD and DJRO. And then the other percentage can be spread out across JEPI, JEPQ as an example. And then if you wanted to follow the guidance here from him, you could allocate to these or some of these other 10 individual stocks that he recommended. But my recommendation is to truly make this a sleep well at night, limit how much you have in each individual stock. Don't go throwing 30% into BTI, 20% into EPD, right? Limit it. What I always say is no more than 5% in an individual stock. And if you do that, you're going to be able to sleep well at night, and you're not going to, be sweating when the market takes a turn. Though given what we saw in this article, the volatility will be less than the overall market, but still, retirement, you should not have to worry about your portfolio. And if you put these guardrails in place, you'll truly be able to sleep well at night. So yeah, I hope that the article was helpful. I hope that the video was helpful. I hope you learned something new, and I will see everybody in next week's video.